contracts or shares, but I like to, I'm very risky, and that's the gambler in me. Like it's bad, y'all. I'm letting you know it gets bad, especially when you start seeing yourself making some money. But I hold myself, I'm trying to learn this year to minimize my risk. I'm trying to bring it down. So you will find yourself getting excited because you're making money. You're like, oh my gosh, like, did I just make my salary? Or like, did I just make my 2-week paycheck? You know, I still have a 9-to-5. I work at the DMV. So I still have a 9-to-5. So you're thinking it's like, do I really want to work still or do I not? So my risk level, I'm trying to bring that down so I can stop working a 9-to-5. And I do have goals this year. So I'm trying to bring that down. Make sure when you're starting off, don't have a high risk level because you're going to get smacked down. And I'm going to let you know that real quick. Real quick. It happened to me. That's why I'm saying it real quick.
Well, I think we just went live on YouTube. So I just want to give an opening and have B say something real quick to the YouTube family that just joined us.
Hey YouTube, guys, it is 7:30. We're about to hone it in. Thank you for asking your questions. Thank you for being here. Make sure y'all talking in the chat. Y'all can ask questions as we go, but I think the ladies are gonna be more teaching. We'll do Q&A at the end. So what I did yesterday, once again, I took my notes and I'm on my phone. So I screenshot all the slides as they're talking. That helps me a lot. And I made a little folder, a cheat code folder on my iPhone. And I just put all the screenshots in there for later. If you guys missed yesterday, if y'all missed tomorrow or another one of these 5 days, y'all will get the recordings. Do not be discouraged. Y'all will have access to all of these recordings, to all of the classes. So if you missed yesterday, y'all can email us, check your emails. Y'all will get the recordings daily. And these ladies are going to teach us so much today. Let them know the topics, Kim. And this is the Ladies Lounge.
Yes.
By Chica. So I'm excited to learn from the girls. Their energy is so vibrant. But once again, y'all, just like Kim keeps reiterating, no stupid question. I mean, no question is a stupid question. I probably should have asked a million yesterday, but I had so many. I was like, just relax. I don't understand nothing. But I'm not, you guys, I'm not, a fake it till I make it type person. I'm very honest, very open. Once again, I said at the beginning, I do not retain information well the first go round. So this will be a journey for me. I'm going on it with y'all. Like I said, I'm screenshotting, I'm taking notes. And after this 5 days, this is going to be an ongoing learning thing, you guys. You're not going to become a pro trader or a professional in stocks in this 5-day course, but you will learn a lot of the basics to get, one foot after the other, to get the ball rolling. And I challenge you guys and encourage you guys to, at the end of this, to join Cheat Code and become a part of their family and really, really dive deep into stocks and learning about it. But today's course will be led by Kim. Chrissy and Twyla are here for moral support. So we will get started. And thank y'all for being here. I love you guys. I'm so proud of every single person that is watching this, because it takes, a minute to sit down, get out of your normal routine. And it's literally like going to school or signing up for an e-course or signing up for a college class. Like, get excited about the outcome of generational wealth and being able to move around and work from home and make money from home and learning a new skill. I know learning can be intimidating and scary and sometimes even, I'm not going to lie, boring, learning about something that you know nothing about, but get excited about the reward, you guys. So enjoy the journey, get excited about the reward, and yeah, let's get going.
All right, so today we're learning about technicals, and my girl Twyla is going to kick it off, and then I'm going to come in at the end and talk to you about real estate investment trust. So Twyla, you want to kick it off?
Absolutely. And Kim, we're talking about fundamentals. She's so excited. Technicals is tomorrow with Becky and Chrissy. But we are talking about fundamental analysis in stock trading, which is day 2. So let's go ahead and get into it. What we will be covering today. As Kim said, she will be talking about REITs towards the end, but I'm going to be giving you the nuts and bolts of all of the information for fundamental analysis. As I said, we're going to turn you into mini accountants without all of the courses that you had to take to get there, right? So it's going to be, what is fundamental analysis, right? What is it? What's the purpose of it? Why do we use it? Within fundamental analysis, we're going to be discussing what macroeconomics is and microeconomics is. We're not going to get in detail, but we're going to give you a brief overview of what those are and how they pertain to fundamental analysis. We're going to be discussing why fundamental analysis is important. Then we're going to head into like the basics, right? The corporate structure and corporate personhood. Corporations have rights, just like we as people do. We're going to discuss that. We're going to discuss what to look for in a corporation, how it is, what their corporation structure is like, understanding what the corporation is. Then we're going to get into some key statistics like market capitalization and volume, how they play a role as far as looking at stocks and their appreciation, dividend and dividend yield. I'm going to briefly touch on that. Kim is definitely going to go into that in more detail when she talks about REITs. We're going to talk about net income, which is profit, right? Everybody likes profit. If your company isn't making profit, then you're not going to pay me as a shareholder, and I don't like that. So I am not going to acquire you as any stocks in my portfolio. Then we're going to get into financial ratios, earnings per share, price to earnings ratios, the price earnings, the PEG ratio, price earnings to growth, price to sales or price to equity, price to book, and then the debt to equity ratio, right? So it seems like a lot, but please believe we're going to break it down in very minimal terms where you're going to be able to digest it, regurgitate it, and be many accountants. And then at the end, we're going to get into REITs and dividends, and then we're going to hit you up with question and answers at the end. So let's get into it. What is fundamental analysis? So it's just a way that investors use to determine intrinsic value. And an intrinsic value of a stock just pretty much measures how much the asset is worth. So when you look at, like, let's say for instance, anything that you look like a McDonald's, Apple, Apple just hit 3 trillion in market cap. So you're just assessing how much that stock is worth, right? So that's the intrinsic value of a stock, and it's negotiable, right? So it's a financial instrument that holds monetary value. So as you know, when you hold stocks, you're holding monetary value. You have invested your money and you're wanting them to make a return on your money, right? Return on investment, ROI. So it's a negotiable financial instrument that holds monetary value. It definitely represents ownership. So like if you own any stocks, you have ownership, right? And then with having ownership, you have rights to dictate to the board of directors what it is that you want to see. Now, of course, you have to acquire enough stock to be able to make that, that inference as far as what you want to see. But as you acquire those stocks, you get invited to the shareholders meetings. You're able to voice your concerns with how the company is proceeding. So it's definitely a key asset. It's definitely, the intrinsic value is definitely going to tell you how much the asset is worth. Now, with intrinsic value, there is extrinsic value, but extrinsic value is more so when you get into derivatives, right? Options and things of that nature, which I believe Quay touched on yesterday. We're not going to really get into that because that's a more complex subject. But when you look at options, there is an extrinsic value, which means that you're speculating on what you feel that the price is going to go to. So just know, if there's an intrinsic value, there is opposite of extrinsic value, and they work well together, right? But right now, we're just going to focus on the intrinsic value, how much your stock is worth, and how much value it brings to you, right? So overall, fundamental analysis is trying to get the detailed assessment of what a company is worth, right? It's through inspection of a couple of key elements, right? You're going to be looking at, fundamental news, because news definitely plays a role into any stock price. You're going to be looking at the big three. I call them the big three: the income statement, the balance sheet, and the statement of cash position. And within that, they have ratios that you can calculate to assess how solid a company is. And as we move forward, we'll definitely talk about that. But overall, fundamental analysis is just getting a very detailed assessment of how solid a company is that you're choosing to invest in, right? So as we said, the first topic is macroeconomics, why we study macroeconomics and what it is. Macroeconomics is the study of the economy as a whole, right? So it's going to give you a top-down approach, right? Microeconomics is going to give you a bottom-up approach, but macroeconomics studies the economy as a whole. It's looking at the big picture. It's looking at economic growth, which is GDP, gross domestic product, right? It's looking at the income. It's looking at inflation. I know you constantly hear about inflation right now and how inflation is high. It's taking those aspects into consideration. It's looking at employment versus unemployment. It's taking all of these elements that affect us in a global fashion and transposing that into how it affects our markets, right? So it deals with performance, structure basis, the decision-making of the economy as a whole, right? And as I said, It includes, gross domestic product, which is the total value of added creation in the economy. So anything that is created that adds value to the economy is considered and factored into the gross domestic product. There are actually 4 types. We're only going to be talking about GDP because that is the one that is mainly gets focused on, right? It's just adding value to the goods and services. So that's what they calculate, right? It's one of the most widely used tools to measure a country's economy. Every country has their own GDP that they measure. And if you look at any graph, we're kind of somewhere at the top. So, GDP is a key element that is used in macroeconomics as far as how to assess the economy as a whole. Now that plays a role in looking at stocks, because if the economy is doing bad, or if we hear any, news that can definitely shift the economy, it will play with the stock price of any intrinsic asset that you hold or any stock that you hold. Because any shift, like if OPEC decides that they're going to charge $2,000 a barrel for oil, when you look at oil companies, their prices are going to be moving in the market and their stock prices are going to be, moving according to whatever information that is being projected on a worldwide schedule. So you definitely have to pay attention to macroeconomics. You don't have to go into deep. Like if you choose to go deep into it and get a better understanding of all of these assets, like, monetary policy, you always hear about Jerome Powell speaking, or if you hear about Jerome Powell on the news and what he does, he actually is a part of the Federal Reserve. So the Federal Reserve Act mandates the Federal Reserve to conduct a monetary policy. And the monetary policy just pretty much predicts, how to taper the economy, how to get the economy in homeostasis, right? So inflation is up because the economy is definitely out of homeostasis. Like all of the factors that go into determine monetary policy are kind of out of line, and they're trying to find a way for it to get back into line. So if you listen to the news today, you heard that they were going to be introducing higher interest rates. So that is going to bring the economy back into line and kind of push inflation down. So it's trying to reach an equilibrium in the economy. And so that's what the monetary policy does. It looks at all key elements based on, employment, as I said, gross domestic product, supply and demand, and they're trying to reach a happy medium to keep everything equal. Because if it's out of whack, then we have high inflation or we'll have high unemployment, and it affects us as consumers and as stockholders, and we have to be able to pivot and adjust based on what the economy is telling us, right? So inflation is the rate of price, the increase in prices over a given period of time, right? So we know inflation is out of whack right now. I believe it's probably around a little bit over 6%, and it's normally not that high, right? And inflation is calculated by the consumer price index, right? So they're looking at everything at 100%. And since inflation right now, it's probably like at 106%. So it's 6% over, which is why they're saying inflation is high. So they're trying to get it back to the equilibrium of 100%. So you just have to take these things into play. So when you listen to the news and you hear like unemployment numbers are high or unemployment numbers are low or inflation is high, it's going to affect the stock price of any stock that you're going to hold, right? So you definitely have to pay attention to that. As I said, unemployment plays a strong role in it, right? I believe an article came out yesterday that people are leaving their job at astronomical amounts, right? But that doesn't mean that they're unemployed. That just means that they're probably finding higher paying jobs. So you definitely want to have that element of it into play, right? So there are key statistics that go into calculating the unemployment numbers, and that's housed through the Bureau of Labor Statistics. So you definitely want to take that into play and take that into consideration whenever you hear about that. And definitely to make sure that you're paying attention to that and how it'll affect any stock that you hold, right? So along with macroeconomics, you have microeconomics, right? So that's the study of individuals and business, and that takes a bottom-up approach, right? So instead of looking at it from a worldwide economic factor, they're looking at it from an individual factor, like businesses and everyday individual. They're looking at labor statistics. They're looking at how we spend our money, how we choose to, how our supply and demand in everyday facets of consumer discretionary products, like where are we spending our money? How much of our paychecks are we spending? They're looking at that. So that's why it's considered a bottom-up approach, because they're looking from in a more magnified way at us as consumers, what we're doing, right? So it studies consumer behavior. It's going to look at, like I said, how people spend their budgets. What's the average budget of, a family in any state? It's going to dictate that. Like, what combination of products and services are the best fit for individuals? It determines like where people want to work, how often they want to work. Do they want to work full time? Do they want to work part time? It looks at, how businesses decide to market to us, what they choose to market to us, what products they choose to sell to us. And it decides, what causes people to go and work for those aspects. So it's looking at us from a microscopic perspective to get our habits and inferring that into the market. So that affects the stock price as well, because if McDonald's is looking at everybody is buying chicken, or everybody is going, I'm buying chicken, then they're going to shift to try to get into that niche. So they're definitely paying attention to what it is that we are consumers are, putting our value in, putting our time in, and they're making the shift in those markets and able to be, accommodating to us. So that's the difference between micro and macroeconomics, but they definitely work hand in hand with each other. So, you get a broader perspective as far as what's going on in the economy, and then you get a more nailed down perspective as far as what we as consumers are choosing to consume, right? So why is fundamental analysis important, and why should we use it, right? So it helps us to make informed decisions, right? If you know that there's a company that you're choosing to invest in because you spend a lot of your money there, then you can look at the financials and look at the position of the company and determine like, okay, this would be a solid investment. But it helps you make an informed decision, as opposed to just taking what your neighbor or somebody across the street said and just going full in. Using fundamental analysis helps you to assess whatever risk reward strategy you have as far as it being a beneficial investment for you, right? It also helps you to determine the fair value of a stock, right? So it helps you determine if a stock is overvalued or undervalued. Like, are you overpaying for it, or are you underpaying for it, right? Most of the time you want to be on the underpaying side, because when it appreciates, that means that the return on investment is going to be greater. So it's definitely going to help you determine how much the fair value of a stock is, right? It helps you to determine the health and performance of any organization, right? But you does it by using quantifiable and crucial information, like the market indicators give us, right? So we're assessing companies in a sector or in an industry, because we're going to want to, run an assessment against peer companies, as opposed, you don't want to compare an apple to an orange, because it's not a fair comparison. But it's definitely going to provide a health and performance of any organization if you get down to the nuts and bolts and look at their financial position, right? As I said, it's going to gauge whether a stock is over or undervalued, or if you're getting it at a discount, or if you're getting it at a premium. So you definitely want to know that. It assesses a company's strength in comparison to its competitors. So like, a McDonald's versus Burger King, a McDonald's versus Taco Bell, it's going to see how it runs in that particular sector. And it's going to be able to determine, hey, is this business model working or is it not? And if it's not, you can delve into, the financials to see what's not working, or if they're making any changes to make sure that it is going to evolve to work, right? It gets down to the core essence of what an organization is, what an organization does, and how they compare to their peers. So it just ultimately gives you an overview of what is this company, what are they doing? How are they looking in comparison to other people in that sector? And if it's the lowest one on the totem pole, you definitely don't want to invest in that, right? You want to invest in quality. You want to invest in ownership, right? If you invest in stock, you're investing in ownership. You own something, right? So you get to dictate as ownership what you want to do, right? So you want to make sure that what you own is going to have a positive return on investment. So, and that leads us to, when you look into what a company does, who they are, you definitely want to look at the corporate structure, right? So every company that's listed on the New York Stock Exchange or publicly listed must have a board of directors. They have to have a chief executive officer. They have to have a CFO, and they have to have a COO. Now, a chief executive officer answers to the board, but they also put together the information as far as dictating to the company the trajectory of where they want the company to go, right? So that's what the CEO does, right? But they answer to the board. And this is where you're going to play a key component into it, right? Now get into it, because the CEO dictates to the CFO. So the CFO must present their financial position. Every company has to report their financials, right? They just have to, right? It's a part of the SEC. It's the 1933 Securities and Exchange Act, right? They have to do it because of the stock market crash in the 1920s. They put together an act that says, look, if you want to be listed on the New York Stock Exchange, you have to abide by the SEC guidelines. So they have to abide by them. And the CFO is responsible in putting together those reports. Now, in those reports, as you see the other two key points down here, they must file a 10Q and they must file a 10K. A 10Q is a quarterly representation of their financials, right? A 10K is the annual representation of their financials. There are 4 quarters in a year. Every company does not have the same fiscal year, right? There is a calendar year, which is January through December, and a fiscal year is just a 12-month period. For me, for the job that I work, our fiscal year is July through June. So our first quarter starts in June. So just be mindful of that. Don't think that just because a calendar year is 12, is 1 through 12, they all start in January. They do not. Every sector has their own fiscal year. So you can definitely take into consideration that. So for instance, we just came out of Christmas. All retail's fiscal year ends January 31st. Now it makes perfect sense, right? It's their 4th quarter, which is normally the biggest quarter for most companies. They're going to report most of their sales in November, December, and January, because that's when y'all spending big money, right? We are spending big money in those aspects. So it's going to be their cleanup quarter. So their quarter ends January 31st. So as I said, it's their fiscal year. Their fiscal year ends January 31st. So be mindful of that. But they have to report all of that information quarterly, and they have to report it annually. And if there are any amendments to that, they have to report adjusted 10Ks and 10Qs, right? And as I said, this is where we play a role in it. As a shareholder, if I hold a number of shares, I get to dictate to the board of directors what's going to happen. Right? I get to show up to the meetings and put my hand up and say, I don't like the trajectory of this. I think that we should change it. Now, if you hold a large amount of shares on that, you definitely get to push the needle a little bit further than, say, for instance, anybody that holds probably 10 shares. But let's say for Microsoft, you own 500,000 shares, right? You get to push the needle. They're going to be listening to you and hearing what you have to say, because clearly you have a large investment in their company. So you get to dictate to the board of directors. If you don't like the board of directors, guess what you get to do? You get to vote them out. And by voting them out, you get to control who the CEO is, who the CFO is, and who the COO is, because the board of directors, appoints those people. So you have ownership, you have control. So don't think because you own shares, you don't have any control. You get to dictate as long as you have enough shares to move the needle. So that's why it's great to have ownerships, to definitely do your due diligence and look at the shares, right? So corporate personhood. Every corporation is protected by the 14th Amendment. So that gives them the right as individuals. The same rights that we have are the same rights that corporations have. So, we hear protests about why are corporations XYZ. They have the same rights as we do, and it's protected by the 14th Amendment, and it's called corporate personhood. So you just have to be mindful of that. They're not exempt. They are held to the same regulations that we are. Of course, they take advantage of the tax structure and the tax code the way that it is, but they have corporate personhood. It grants them the same rights as us as individuals, right? But the number one priority of any corporation is to return value to its shareholders, because if you're not paying me, I'm not paying you. What does that mean? If you're not going to give me a return, if your stock is not going to appreciate, if I'm going to be losing money on my investment, I am not buying any more shares. And they know that. So if their stock continues to tank or any of that, and they lose investors, it depreciates in the share price, and they don't want that. So the number one priority, albeit whatever people say, it is to return value to you as a shareholder. So you want to make sure that you're picking valuable stocks, right? Understanding the corporation, right? When you pick a stock, you have to understand what the company produces, what the services or products are. So this is where your due diligence comes in, right? You have to understand the company that you're investing in. It's always nice to hear people talk about things to get in, but you have to do the legwork to make sure that it aligns with your goals, right? I, for one, am a blue chip girl. I only invest in blue chip stocks, but that's me personally. I have some REITs and I have some growth stocks as well, but you're going to see me, I am a blue chip girl. You have to understand the sector that the company falls under, right? And there are 11 different sectors: information technology, healthcare, financials, consumer discretionary, communication services, industrials, consumer staples, energy, utilities, real estate, materials, right? So those are the 11 key sectors that all of the companies fall under, right? They're going to fall under it. So like an AT&T and Verizon, or, Comcast. Comcast could fall under information technology. It also can fall under communications. So any major company falls into these categories. So it's definitely great to know the sectors. Now, if you're scared to tip out and buy, individual stocks, you can definitely invest in the sectors, right? Because it's going to give you the top 10 holds of that particular sector. So like Amazon and Microsoft and Nvidia would be a top 10, or Tesla would be a top 10 holder in like a technology sector. You can invest in that, right? The price point is going to be minimal. The return might not appreciate as fast as actually owning the stock, but you get to, if you buy that ETF, you own all of them, right? So you can get exposed to a lot of different companies in that aspect. So you definitely want to be familiar with the sectors, right? There are 24 industries, 69 industry groups, and 158 sub-industries. So there are a lot of different companies that are broken down in a whole bunch of different industries that fall into these sectors. But definitely you can look at industries you want to be exposed. You want to have a diversified portfolio. So you don't want to have all your eggs in one basket. You want to be exposed and diversify it. But you can definitely look at companies in different sectors and different industries, right? You want to get a general understanding of the corporate structure, as we went over. Who's the CEO? Who's the CFO? Who's the COO? Like, have they been terminated from any of their other positions? If they did have other positions, did they get promoted to this company because they think that they can bring value or appreciate the stock price? You know what I'm saying? You have to look at that. And then you have to research the financials, right? So you're going to have to dig into the financials. And as you dig into the financials, you're going to come across things like market cap and volume. So market cap is pretty much, it's the total dollar market value of a company. And you arrive at that by taking the number of outstanding shares by the share price. Now, Apple made news because it hit market cap of 3 trillion. This is a little outdated, y'all, but it hit 3 trillion, right? So in the grand scheme of things, it would be considered a large cap, right? Because it's 10 billion or greater, right? And the S&P 500, the NASDAQ, and the Dow Jones Industrial Average normally has a lot of large cap, right? As I said, I'm a blue chip girl. A blue chip girl, it just means that they're industry leaders, right? Their business model is dependable. They have a proven track record and strong reputation with consumers and shareholders. So a lot of blue chip stocks are going to fall in your large cap, right? You have your medium cap, as you can see, between 2 and 10, your small cap, 302 billion, and micro, 500 million to 300 million. Now, you can definitely hold a mixture of any of these. I hold some medium cap, I hold some micro cap, I hold a lot of large cap. So it just means the dollar amount time multiplied by the sales price, and that gives you the market capitalization. The volume that comes in is normally like the amount of traders that come in any trading day. So it's the volume of stock that is being traded throughout that trading day. As you can see on the slide here, if you were to look down under key stats, you see the volume. So on any given day, 50 million shares of Apple are being traded, right? So you're looking at that. The average volume is 115 million, and then it gives you the market cap and the dividend yield. As I said, we'll discuss dividend yield, and Kim will get into it a little bit more in detail. So you definitely want to pay attention to market cap and volume. Most market cap companies or blue chip stocks are going to pay a dividend. As I said, Kim will talk about that in a minute. They just have more stable business models. Now, not all blue chip stocks and large cap companies are going to pay a dividend, but the likelihood that they are is going to be greater because they have a more established, stable business model, right? So as I said, dividend yield. So a dividend is just a quarterly or monthly. There are companies, as Kim will discuss, REITs that pay dividends monthly. Most of them pay quarterly, right? So it's paid out of its profits, right? And a dividend is just pretty much a token or a reward to the shareholders for investing in the company, right? For believing in the company, and it's going to be paid out of the retained earnings. So retained earnings is the pot of money that's made of profit that a company has made. They've had this net income, they've made this profit, they move it over to their retained earnings. And from that, they carve out a part because, hey, we value you as shareholders, because that's the number one thing to give to shareholders. We value you. We're going to pay you out of this money. So any extra profit that they have, they pay out a dividend. Now, as I said, not all companies pay a dividend. Some of them take that retained earnings and just reinvest it into growth. And that's okay too, because most startups, most new coming companies that want to expand in their market share, they're going to take their returned earnings and they're going to reinvest it in their company. And if you're reinvesting in your company, that means that you're trying to grow it out. You're trying to make my share, the shares that I have, appreciate. And I'm okay with that. You may not pay me right now, but you're going to pay me in some way, and I'm coming to collect my money, right? So when you look at dividends, you look at it like that. They get paid quarterly or they get paid monthly, right? The dividend yield pretty much tells you the percentage that a company pays out per year. So as you can see here, Apple doesn't pay a dividend, like a strong dividend, right? You get 88 cents annually for every share that you own. But if you own a lot of shares over years, you can live off of dividend income, or you can reinvest it, which is called dividend reinvestment, right? You take the dividend, you reinvest it back into the stock, it appreciates your stock price greater, and then you take that and just continue to reinvest it. Eventually, you have enough shares, you can live off of dividend income. So the dividend yield for Apple at this time was 0.5%. Is it a lot? Absolutely not. But if you have a whole bunch of dividend paying stocks, as well as a whole bunch of shares, it's going to pay nicely, right? So you definitely want to get some dividend paying stocks, right? And when you're examining a dividend, you definitely want to double check, right? You always want to do your due diligence. You always want to double check. So you can go to websites like NASDAQ.com, dividend.com, Morningstar, Market Watch. They'll all give you aspects to check dividend and dividend yield. So net income. Net income is it's the bottom line. It's the net. After you take out subtracting expenses and taxes, depreciation and amortization, those two are they're not really on the balance sheet because it's a line item that doesn't get counted. We're not going to go into that. Just know that it's the net income takes that into account. So, you get all your revenue after you subtract all your expenses. This is the profit that your company is going to pay you, right? So you're looking at it. So for me, as you can see on the slide here, the net income is what's higher. Highlight in blue. You're definitely looking for a year-over-year increase, right? You want to make sure that they're returning the profit to their shareholders, because hey, if they're making a profit, I'm making a profit, and it's the bottom line. I liken it to, if you're employed or you're self-employed and you get a paycheck, right? You get your gross, they're going to take away for medical, they're going to take away for dental, they're going to take away for like any other expenses that you want to come out of your check. And you have that net pay that you're going to live on, right? Same things for companies. They got that net income that they have to use that gets trickled over to retained earnings. Now, you have to be careful because sometimes companies can inflate or kind of, trick around with this. So that's why you have to be inspectors to make sure that it lines up. And, you can look at the net incomes and it gets carried over to the balance sheet into the cash position. So you can definitely look at it in that way. But when you're looking at net income, it's the basis. So you want it to always be positive and you want it to always be growing. Just like any paycheck you get, you want your paycheck to be growing because it's the money that you choose to live off of. If it is negative, like with us, if our money don't come in, we don't called out sick, we don't have no sick days, they take money, what do we resort to? We resort to our credit cards, we resort to loans. It's the same things with companies. They resort to going to banks to getting loans. And if they are over leveraged in debt or acquiring debt, they can issue debt as well, as far as issuing debt instruments to collect money. And that's a very viable way because then they get the interest and payments, but they can also go out and secure loans, which means that, hey, we didn't make no money. Y'all have to give us some money. And if we can't pay this back, it's bad, right? Because then they're going to liquidate, they're insolvent, companies go under, they declare bankruptcy. So when you look at the net income, think about it as your paycheck. You want your paycheck to grow every year, you want their net income to grow every year. So net income definitely is a profitability metrics and it returns value to the shareholders, right? So then you're going to get into earnings per share. So earnings per share is a company's net profit divided by the number of common shares it has outstanding, right? It indicates how much money a company makes for each share of its stock. It's a widely used metric for corporate valuations. So, as I said, you're taking the profit divided by the the outstanding shares, and you're going to get profitability. Now, I'm a profitability girl. I need you to be returning profit to me for anything I own of yours, because if not, you're not going to be in my portfolio long. You will get sold on the next thing smoking. As soon as market is open and I feel that you're down, you will go. So I want you to return profit to me. So it's assumed that the higher the earnings per share, the more profitable the company is. And there are two types of earnings per shares, which is basic and diluted. Diluted is just, if a company offers stock options or any, compensation in stock to their employees, it kind of dilutes the basic earnings per share. So you'll see it on any income statement where it says basic and diluted. Just know that diluted takes into consideration that they're accounting for stock prices that get paid to their employees, right? So then from earnings per share, it can definitely be arrived at several different ways, right? They can exclude extraordinary items, discounted operations, or diluted basis, which are like line items that are on the income statement. You don't really have to go into that because earnings per share is normally calculated for you on any income statement. So all you have to do is find the line item and look for a year-over-year increase, right? So then that leads us to the price to earnings ratio. The price to earnings ratio, it's a valuation of a company, right? It's going to match apples to apples, right? So as I said, when you look at companies in the same sector, you want to match companies that are the same. It's not going to, it's no good for me to compare an Apple to a McDonald's. They're not the same, right? It's not going to give me a fair comparison. Now, what you can do is take their business model to see if it works and be like, I could take some of their key components and apply it to my business model to see if it'll give me the returns that they have, but you don't want to compare that, right? So it just measures the current share price, and it takes the earnings per share. The share price is divided by the earnings per share. So of course, as I said, the earnings per share is given to you. You can get the stock price or the share price on any platform. And you just, divide that and it gives you the price earnings ratio. So the average PE ratio is around 20 to 25%, but take that with a grain of salt because every industry is different. So it's not going to be a 20 to 25% across the board. You have to research to see what the average PE ratio is for each industry or each sector. So you'll have an accurate comparison because I believe semiconductors PE ratio is 10. If you're thinking that it's 20 and you see it's 10, then you're thinking like, oh, this is undervalued. Let me buy it. It's really not undervalued because it's for that industry. It could be high for that industry, that the average for that industry. So you definitely have to do your due diligence and researching in that way to see what PE ratio is for each industry. But overall for the S&P 500, it's 20 to 25. If it's under 20, then you're like, hey, this is great. It's undervalued. I should get it. If it's over 25, hey, maybe it's overpriced. I'm going to be paying too much to hold this. Maybe I should wait for the price to decrease and get in there. But as I said, take it with a grain of salt because you have to look for the PE and the PEG ratio for each of these. Now, the PEG ratio, it is not on here. It is the same thing as the PE ratio, but it takes into consideration the growth factor. So any like upcoming company, they may not have, a high earnings per share or a high share price. But if they're, as I said, taking their retained earnings and reinvesting it in growth, their PEG number could go up. So that just means that they're, if they have a high PEG, that means that they're, in a growth cycle, and it's great to hold. If you believe in the company and you believe that it's going to appreciate over a period of time, then you definitely want to take into consideration the PEG ratio. When you look at blue chip stocks, it's probably not going to be at the PEG ratio is going to be lower because, as I said, it's a stable business model. They really don't shift too often, but they return a dividend. So you just have to weigh those things out, right? So then you have your price to sales ratio. So price to sales ratio It takes in consideration the market cap, as we talk about, which is the total number of outstanding shares divided by the total revenue. You can get that on any income statement and just look at whatever fiscal year you're looking at, because why? They have to report a 10K or else they're not listed on the New York Stock Exchange. They have the OTC market. We will not talk about that because that market is a little bit shaky, but they can go on over there and report over there. So anything that's listed on the New York Stock Exchange, you know, they have to report their 10K. So you can just go in and grab this information off. You take the market cap number and divide it by the total revenue, right? The price to sales ratio pretty much shows you how much the market values each dollar of that company sales. So it's just, you know, you're just valuated on their sales, right? So you're getting a valuation technique on that. And the industry specific, if it's below 1, it indicates an opportunity that, you know, it's a great way to get into purchasing the stock, right? But you have, as I said, take it with a grain of salt because everything is industry or sector specific. So you definitely want to look at the sectors that you're choosing to invest in and make sure that they're what their price to sales ratio is, and look at the metrics to make sure it aligns with what your goals are. And if it's undervalued or overvalued, then you can go ahead and get it. The market has been trending for the past 20 years at 1.55. As I said, it's the norm is under 1, but the market has been trending at 1.55. So you have to make that assessment and that adjustment. And that's why I say you have to go in and look at your specific sector and industry to make sure what their price to sales ratio is, to make sure that you're getting a, you know, to assess if it's undervalued or overvalued. You also have your price to book ratio. It just is, it's used to compare the current market to its book value, right? It's a valuation technique as well. Typically, the higher the book value of a company just means that, you know, the profitability of the company is there, their valuation is a little bit higher, right? So it's used to value investors, you know, on potential investments. It's just another metric like the price to sales ratio to definitely give you an aspect of if the company is undervalued as far as like, is it a good buy time, or if it's overvalued and you want for a retracement or to see if the stock pulls back so you can go in and buy shares, right? The ratios under 1 are typically, you know, most desirable, but as I said, take it with a grain of salt because you definitely want to look at the industry or sector that you're looking to invest in and see what their price to book ratio is to make sure that it's in line with whatever company you're choosing to invest in, right? And last but not least, we have the debt to equity ratio, right? So the debt to equity ratio, it's a financial leverage tool. It determines how a company is dependent on money, right? So for me, the optimal debt to equity ratio, it varies by industry, right? So everything here is industry specific. So if you're looking at stocks to invest in, you have to do your due diligence and look at the industries that they're in, because the numbers are going to shift based on the industry and the sector or the items that they produce. So just don't take one blanket number and it runs across the board, because unfortunately it just doesn't work that way. But so you have to do a little bit of due diligence on your part. But optimally, it never should be above 2, right? Because what that means is that a company relies on debt to finance their day-to-day activities. We don't want that, right? You don't want to rely on debt to finance your day-to-day activities, because them people's coming looking for their money. And when they come, you have to pay their money or you're going to pay the piper. So when you look at that from that aspect, you want, me personally, anything under 1.5 is cool, because that means that they're using the equity in their company, which means the revenue that's being projected and the revenue that's being attained and carried over into retained earnings. They're using that money to finance their day-to-day operations. Is it okay to have debt? Absolutely. It is okay for us to have debt as well, right? I'm not saying don't go out and get no credit cards or whatever. We'll do what you got to do to make your life workable for you. Just don't become over leveraged in debt. It's the same thing with companies. You do not want to get invested in a company that's over leveraged with debt, because that means that they're going to be going to exorbitant hoops to try to finance that and try to pay their collectors what cuts into the profits. And as I said, if you're not paying me, I'm not paying you. And I don't want you to take any profits owed to me. I want the stock to appreciate. And if you're taking profit to pay off your debt, that means that you're not returning value to me, which means that I'm not returning value to you. So I'm going to walk away. So it's okay to have a debt to equity ratio. Anything under, industry specific, and I say take that with a grain of salt, is 2. Always look for anything 1.5 or below, because that means that they derive most of their responsibility from the equity that they provide in the company. So those are just key elements that you could use as far as looking at the financial statements to determine what ratios you need to use to assess if the company is good. There are a multitude of more that we could discuss. Come on over to the Cheat Code Discord. I'll be there answering questions. I'm always there. Fundamental analysis, right? That's what I'm doing. So you can come over to the Discord and ask those questions, and we can definitely get into more detail and break down other key factors. But other than that, I'm gonna go ahead. Oh, let me say here, this is the financial representation of what the ratios look like. So as I said, they're valuation ratios. You have your price to earnings ratio, your price to sales, price to cash flow ratio, price to book ratio, debt to assets, debt to equity. As I said, there are a multitude of other ratios we can discuss that are represented on any financial any represented from any financial information that you can derive. You don't actually have to do the calculations. I'm a nerd. I still sometimes do them, but you definitely don't have to, because they're provided for you. And you look at the industry that you're in and compare it to the industry specific ratios and align to see if this is an undervalued stock or an overvalued stock. And then you're able to make your assessment as far as buying in. So without that, I'll shoot it over to Kim so she can go ahead and explain to y'all about the REITs that she's going to talk to y'all about.
Like, was I muted?
Yeah.
Okay, I did a whole intro, bruh. Okay, so hey y'all.
You were definitely muted, Kim.
Y'all know y'all saw me moving like, okay, here we go.
I was like, she's miming.
She's miming.
Baby girl.
I can't stand me, y'all. Hey y'all. So first of all, shout out to my girl Twyla, because I was not a math person in school, and Twyla broke it all the way down for y'all. I was on my calculator, y'all, like, let me get this market cap. So shout out to her. So I'm going to teach you a little bit about dividends and REITs. So first of all, how many of y'all have ever been like on Zillow or like on Redfin and be like, oh, that looks good. Oh, I want that mansion, right? And we thought about, man, it would be nice to, own something like that. I'm going to tell you how without having to go to Zillow, without having to look up a realtor, saving for your down payment. That's the whole situation with buying a house, y'all. But the idea of getting a rental is so much easier than doing all of that. We can use a vehicle called REITs. So if right now you are renting an apartment, I want you to put a 1 in the chat. If you are paying a mortgage on a house, I want you to put a 2 in the chat. There we go. See, because some of y'all, look, I know some of y'all ain't homeless because y'all got Wi-Fi. So it's one or the other. So I know that y'all right now are so excited. Y'all are going to be in there investing in your future. But I'm going to tell you an even easier way to make passive income than trying to get a rental property. It's called REITs. All right. REITs are real estate investment trusts. So when we are looking at real estate, the best thing to do with REITs is to essentially think about it the same way as you think about a landlord, the same way that you pay your mortgage every month, the same way that you call your landlord and say something's broken again, but I'm still going to pay my mortgage or my rent, is the same thing that companies do. So companies essentially own all of these 7-Elevens, the Walgreens, the FedExes, the Big Lots, whatever, the malls, the Sephoras, whatever. They all rent space from a company. Now that company, just as much as you go to the mall, just as much as you pay your lease or mortgage, you want to get paid by those companies that you're paying. You hear me? You want to get paid. All right. So I'm going to show you how. I'm going to break it down for you bit by bit. We're going to learn together. So first of all, I said REITs are real estate investment trusts. So the high dividend yield. So once again, just as Twyla talks about, dividends are when a company, you hold a share or a piece of that company and they pay you for holding it. Thank you, girl. Here's 25 cents, right? Shout out to AT&T because they got a really good dividend. or used to. It changed recently. But REITs like SPG, we're going to get into, pay you the same way. So basically what happens is real estate investment trusts, just like a company, says, okay, I got to pay taxes, but I don't really want to. I don't really want to pay taxes. So the government says, say less, sis. If you pay out 90% of your income, guess what? We'll help you, give you a break on taxes. And they're like, ooh, got you, say less. So what they do is they pay whoever holds a share, or in terms of REITs, they're called units. Whoever holds one of those, they're going to pay you every single month. Those are called dividends. Now, the dividend yield, which is like the percent that company pays out every month, might be different depending on the company, depending on the REIT. So we're going to break it down a little bit. So there's a couple of different models here. First, let's consider the landlord model, right? I go to an apartment, I rent an apartment. Every month they say, hey, you owe me for your dishwasher and your bed and blah, blah, blah. You have to pay me rent. I pay them. What a REIT does is exactly the opposite. I buy a part or a share or a unit of that company, and they say, okay, we made a lot of money this month, so we're paying you. Thank you so much for believing in our future and blah, blah, blah. Here's a dividend. I say, thank you very much, and I keep it. Now, there's two things, like we talked about. Say two. If you said two, put a 2 in the chat. There are 2 things that you can do. 2 things. Thank you, Jen. Jen is always honest. She with the 2. So you can do one of 2 things. You can put that in your pocket and say, thank you, ma'am, I'm going to buy some lipstick. Or you can do what's called a DRIP, which is dividend reinvestment plan, and say, okay, I want to give this money back to the market, and that money will then be reinvested. I can get more shares. So then next month, I get even more dividends. Then I can put it back in the market. And the next month, I get even more dividends. So it's essentially a vehicle that you can make passive income without doing any kind of shopping on Zillow. Got it? All right, let's go to the next slide. Twyla's helping me on the slides today, y'all. So how do REITs work? REITs work like it's operating like it's owning a share, just like companies slice up like a piece of pizza and you get that slice, and that slice is like a share. REITs do the same thing. REITs are really popular because they pay high dividends, higher than corporate and government bonds, sometimes higher than shares. And typically, like the shares that are traded on exchanges, kind of like what Quay talked about yesterday. When you go on a brokerage, you're like, hey, I don't feel like trading today. I just really want to start building up passive income. You start to invest in REITs. So these are measured by the REIT index, the MSCI US REIT index. And the average for most REITs was about 10.32, which is pretty high, of June. So we've been through, if you tried to buy a house this year, if you've tried to buy a house in the past, you know that COVID has affected housing prices. You know that, 2008, 2009 crash has affected housing prices. So if you see a company that has made it through, like never would have made it, they made it, then to you, that says, okay, this company might be around for a while. This company might have a consistent dividend, growth, and market cap. Like they're bringing in money. They're still bringing in money. Yes, Marvin Sapp, I almost hit the high note, girl. And they are definitely able to sustain a more development. They're able to expand. So guess what? They're able to pay you on time every month. My God. So what are we looking at here? So dividends are cash flows that are received by the investor, me, from profits generated by a company. So that looks like different depending on which company it is, and we're going to get into that a little bit. So what you're going to look for, I'm going to show you in a second because we're going to do activity. What you're going to look for is a company that has consistent gains, just like Twyla said. They're going to have a consistent or a consistent dividend yield, or a growing dividend yield, a reasonable P/E ratio. I hope y'all are paying attention, or the market cap. And there's different delineations. There's stuff like Apple and Starbucks, who clearly have been doing well. I drink Starbucks almost every other day. And they're going to have a little bit more consistency than a stock that might be struggling to maintain a dividend yield, or a company that doesn't pay dividends or had to take back dividends because they don't have enough money to cover their debt. If y'all not paying y'all bills, I'm not trying to invest in y'all, okay? I'm not trying to be there with y'all. So what you need to remember, as we are moving from financials to technicals, we're going to be starting to look at charts. We're going to be starting to look at companies as a whole. So what you want to pay attention to, and right, I just said DRIP, right? That dividend reinvestment. What you want to pay attention to is something called, and I didn't write it here, but I'm going to say it out loud, so you got to pay attention. You ready? You want to pay attention to the ex-dividend date. Sorry, I'm going to say rate. Ex-dividend date. That is the day that you have to own this company to get paid. So they're saying, look, you didn't believe in us. You know, back then they didn't want me. Now I'm hot. They don't want me. That's the same type of thing. You want to make sure that you own that share by the ex-dividend date, and they will pay you. If you don't, they'd be like, whoop, too late, girl, catch us later. Okay. So when that happens, when they pay that ex-dividend date, the share price is going to dip a little bit, and then it's going to go back up. Why? Because they're paying everybody. They have, you know, $10,000. They got to pay out 90% of that, because remember, they're paying lower taxes. So they got to pay out 90% of that. So their share price is going to dip, and that's when you get your cash, right? So if you're like, man, I missed the ex-dividend date, I didn't have the share price for it, it's cool. Buy the dip and then ride it back up, right? So then you hold it, but your money is also worth more. All right, next slide. So this is what we're about to do together. I'm about to show you, now you understand how dividends work. I'm gonna tell you how to get paid monthly. You hear me? Monthly. So there are REITs that pay out quarterly. If you have a quarter, you know that's not monthly. REITs that are, because the year is divided into quarters, right? So you can have REITs that pay out every quarter, and then REITs that pay out every month. Now, I don't know about y'all, but I'm trying to take longer vacations and sit on a beach and get paid passively. I'm not trying to work, like B was talking about earlier. Like, you know, she does this stuff. She wants to do this stuff for fun. Like, she wants to be out doing comedy shows and kikiing it up with her friends. And look, whoop, bring, I just got paid, right? That's how we all want to be.
Period.
And the T, sis, and the T. So period, poo, we trying to get paid. So the idea is that you guys are going to look up REITs that pay you every month. Twyla always says, a little pop-up, you're like, bring, oh, I got paid, and you go on about your day. And all you have to do, all they're asking you to do is hold the share by the ex-dividend rate date. So what I'm going to show y'all how to do is look up REITs that you already shop at and get your money back, okay? So there's some examples of monthly REITs. Remember, you're looking at REITs that have a consistent dividend payout, right? So you're going to want to find monthly REITs. Some examples of these are AGNC, which is American, you have to write these down, American Capital Agency Corporation. This is really fire. They just did a big acquisition. LTC Properties, Medical Properties Trust, which is MPW, SL Green Realty, and Stag Realty. Now, in those parentheses, that's what's called a ticker, okay? That means that when you go and type in like AGNC, right, it's going to pop up American Capital Agency Corporation. I'm gonna show you in a second. It's going to have all the information about that company. It's like a cheat code. Wink, you know? It's like a little cheat code that the system says, we're going to give you this stuff, right? So once again, I'm going to emphasize it again. You're looking for something that has a consistent dividend rate, a good P/E ratio, and a high market cap. It can be a lower market cap, but in general, since we're just starting, look at something that's bringing in money. Now, for those of us that are like, oh, dang, SPG is $134 a share. Remember yesterday what we talked about, you can buy fractional shares, which means I'm gonna buy $2 of the share today. And then next week, I'm gonna buy $5 of the share. So if you want a very extensive share like SPG, like we're gonna talk about, owns malls. So if you today went to, I don't know what malls are in Atlanta. What's that mall? They got the lines outside of H&M. I don't remember. But Lennox, thank you. Right. There's like 5 or 6. They're like, Kim, come on, Atlanta's big. But like in general, if you went to the mall that mall is owned by SPG, Simon Property Group. So if you own a share or a unit of Simon Property Group, they pay you for doing it. They say, hey, you shopped at Sephora, we're going to give you a dividend. And that dividend is nice. Okay. So the more shares you own, the more you get paid every month. And not every company is expensive. I was just looking up one earlier today. I'm gonna give you the cheat code in a second, but it was $8 a share and it paid out 18 cents. I can afford $8. So that means I'm getting paid 18 cents. Now, 18 cents, don't sniff on it, because 18 cents adds up. $8 today. I'm gonna skip a lunch today. I'm gonna eat at home. I'm gonna buy another one of those shares. Next thing you know, the shares are buying you lunch. You hear me? So the idea is that you can get your discount and have them pay you. The last thing I'm gonna say about this is it can get complicated in doing the calculations. So make it easy on yourself. Use screeners. Screeners are something that screen the market, and they auto-populate it for you. So I'm gonna give you some resources to do that. Once again, what you're gonna look for is qualified or non-qualified dividends. So that gets a little complicated, but basically there are qualified and non-qualified dividend payments for tax purposes. Non-qualified, which are REITs, have to pay out 90%. They have to legally pay you 90% of their income. So that's why it's good. Here's some resources on the page, right? Write these down or screenshot it. Investing.com, finviz.com, REITs.com, CNBC, I watch that every morning.com, SureDividend.com, NASDAQ.com, and Yahoo Finance. All of these have information about REITs, and we're going to do a little puzzle in a second that shows you what I'm talking about. Okay, next slide. Okay, here's the fun part. All right, here we go. So I know somebody was asking about the $8 REIT. I'm a kinesthetic learner. I have to learn by doing. I can write it down, I can hear it, but I'm gonna have to hear it a couple times before I get it. So we're gonna do 2 activities back to back. Are y'all ready? All right, here we go. First thing, everyone take out your phone. Hope you paid your cell phone bill, because you're gonna need to either use that or Wi-Fi. Go to REIT.com. That's REIT.com on your phone. I did this earlier, so I wrote down the steps really specifically. Something should pop up. It says "Nah REITs." This is a real estate investment trust directory and network. You can find anything that you need to know about a real estate investment. So there's 3 bars in the corner. You're gonna push it. Then you're gonna go to you're gonna go to investing in REITs. It's the second tab. Click it. You're gonna scroll on down to where it says REIT directory. Click that. If I'm going too fast, I wrote the instructions on the screen for you. Scroll down. The first couple things that should come up, Digital Bridge comes up for me. Tanger Factory Outlets comes up for me. Core Point Lodging. And you scroll down, you can hit Simon Property Group, just like I was saying. For example, let's just click on one. Let's click on Simon Property Group together, right? What you're gonna see is, it says Simon Property Group. And it scroll down, it says $134.03. Oh Lord, I almost passed out. Jesus, why? Don't worry, you can get a stockpile, break it up for yourself, okay? But let's say that you wanted to do this. You scroll down, it gives you all of the information with a 4.05% yield, right? Last paid dividend, $1.665. So look, this is how you find REITs that you like. So it is literally like you could keep scrolling, just find the REITs. Oh, I don't like that price. $6.98. Digital Bridge it's a REIT. It's the top one, right? I can afford $6.98. Things like that you're going to look for. Then you're going to look for the dividend yield. So you're going to say, okay, I don't understand. There's all these different dividend yields. All right, just write down ones that you like. Write down ones that you're like, okay, I can afford that. I can do this. Yeah, Kim, I got it. I'm with you. Cool. Now you got it in your head, right? Next. I hope that you wrote down at least 1 or 2, because I'm going to take you to the next part. Next thing you're going to do, open up a new tab. And if you have an iPhone, that's a little box in the corner, right? Open up a new tab. Now, you're going to type in the search bar www.nasdaq, NASDAQ.com, and click enter. Now, when you go to NASDAQ.com, it looks a little something like this. You're going to push those 3 lines in the corner. It's going to have a drop-down menu that says market activity. Push market activity. Go ahead and push market, push market activity. Now, there's a couple things that you can do, but if you scroll down, oh, sorry, you know what? I done skipped over a step. Lord have mercy, bless me. If you go to NASDAQ.com and you click those 3 lines, and you, oh no, I did it right. Okay, you're gonna push market activity. It's gonna have a drop-down menu that looks like this. Okay, what you wanna do is you wanna scroll all the way down so you see something that says dividend history. Okay, dividend history. My mother's a preacher. So when it comes like a screenshot, it's gonna say, it's gonna give you the top dividends, just like that. That's it. It gives you Apple, Starbucks, Microsoft, Cisco, and some of these you might already be using today. Some of these you might already or have in your portfolio, or some of these you might never heard of it. Now we're gonna do this together. Everybody, under the sound of my voice, click on Starbucks. Boom. Just like that, it gives you a screenshot. You could screenshot this. You could scroll this. It's $110 a share. However, if you scroll down, look at that payday. You know, when people ask you about your paycheck stubs, that's what this is. These are paycheck stubs. It says 49 cents. So every 3 months, it pays me 49 cents. Boom. And that's it. That's it. You can literally go to REIT.com, look up a stock, then go to NASDAQ and see, when am I about to get paid? When am I getting paid? What dates am I getting paid? Put it on a calendar. In fact, if you scroll down, they even have what's called a dividend calendar. You could buy a different dividend and get paid every day. I wouldn't suggest it because some of these dividends are, they're random. But you could be like, I'm going to schedule my payment schedule so I can get paid every day. That's how easy this is. And I'm telling you guys, this is the cheat code, because we're going to learn, 1, how to trade options, how to trade stocks, but 2, let those stocks pay you. Why you got to do the heavy lifting? Let those companies pay you. And this is what they don't want you to know. All right. So number 3, you can look at that dividend calendar. It's on the same page. You just scroll down. You can get a dividend calendar by month and say, all right, January, I want to get paid the 15th, the 18th, the 23rd, and my birthday, the 28th, right? And I want Ed to pay me. This is how much I need to get paid. And you reverse engineer it, just like that. Okay, so run it once again. I want to run it back. What's important to listen to before we move on to our next activity? Number 1, you want to look like a good ROE, return on equity. You want to make sure that this company is competing with other companies. You don't want a company that's barely but making it. I can't bank my life on that. I can't plan my next vacation on that. I want some company that's going to be here just as it's been here. Good history, good future. Not always, but kind of. A low debt to equity ratio. Can they cover their debts? Just like Twyla was saying, sometimes you want to run up a bag on your credit card, but are you making enough income to pay down your credit card debt and keep a good credit score? Same thing. Companies work the same way. You want to make sure that they're paying their debts on time every month. Number 3, a consistent dividend yield for growth. Is the company growing? Are they expanding? Can I manifest my life off of these expansions? That's how important it is to do your research. And Twyla gave you the major key in looking at the financials. So I'm trying to give you the key in getting that passive income. You hear me? All right, next. All right, we're going to do another activity. All right. Wait, no, go back one. My fault. I skipped it. She said, it don't go back. It don't go back. Okay. We're not going to worry about the back button. We're not going to worry about it. All right, everyone take out a sheet of paper.
Like, I'm going to go.
She said, don't go back. It's okay. Everybody take out a sheet of paper.
Got my
Don't look at the screen. Just hear my voice. Are you ready?
Ready.
I want you to think about the places that you've been the last 4 days and write it down. Take 30 seconds, write it down. I went to the gas station. I went to the mall. I went to my grandma's house. I went to the grocery store. Write it down by name. I'm gonna do it with y'all. I'm not playing. I'm gonna do it right now. You got 20 seconds. Try to remember everything you went. I know it's COVID outside. You might have only 3 places. That's okay. Write down those 3. I went and got a COVID shot. I went and saw B. Simone in Washington, D.C. Whatever it was. Write it down. You got 10 seconds. Come on, you got a little bit more. Got a little bit more in the tank. Where'd you go this week? Don't skip. I know you got that Slurpee. I saw you at 7-Eleven.
I definitely got a Chick-fil-A smoothie.
I got a smoothie too, girl. I got that. Man,
That
smoothie.
cookies and cream.
Ooh, yummy.
The devil.
Peppermints?
The devil.
I tell you what, I be trying to do B. Simone's crunches. I be getting lured by that peppermint smoothie. Y'all got it? All right, ready. People saying it. If you ready, put in the chat, say ready.
Ready.
We ready. We ready. All right. I'm gonna give you the cheat code. Here we go. Ready, ready. I see ready. Jen says ready. Keisha says ready. Kai says ready. All right, we ready.
Go, let's go.
Here's what it is. Every place that you put down, rinse a space from a REIT. Every single place that you put down, rinse a space from a REIT. And I'm gonna tell you, on mine, I put down 7-Eleven because I just got gas earlier. That is owned by Realty, which is ticker O. I put down the mall, SPG. That's owned by SPG. I put down Walgreens. That's owned by O. I ordered something off Amazon. Amazon is owned by STAG. So now y'all can look at the screen. Some of y'all cheated. It's okay. I won't tell Jesus. Some of y'all have lit to, what's it called? Makeup, have gotten to makeup. You went to Sephora. Most Sephoras are located in the mall, just like we talked about Lenox Mall. Who owns it? SPG. Now we just went through how to look them up on REIT.com and NASDAQ.com. Now you can see how much they're about to pay you. If you went to the hospital and got a COVID test, or if you were in the hospital and got a COVID test, you can look up MPW, Medical Properties Trust. They pay out 5.2%. That's a nice percentage. And they own most of the hospitals, clinics, dental, whatever. They own most of them. You went to go visit your grandma, grandpa? If they're at a senior living facility, then they're owned by LTC. That's 5.8%. They're paying you to make sure that your grandma eats her num-nums, okay? What about Amazon? How many of y'all ordered something on Amazon? That was me. They'll pay STAG. So you want to make sure that whether it's digital marketing, if you went to the movies, if you want to, wherever you went to, you want to make sure that you get them to pay you, right? So next slide, I think this is one of my last one. There we go. So the last thing I'm gonna leave you with is this. So this looks complicated. Don't steal it. I copyrighted it sort of. But what you're gonna do is do this for yourself. So what I did here is I reverse engineered it. On the left-hand side, you're gonna see the name of the company. Then I looked up, what is it? It's a REIT. I looked up their ticker. Those letters that I was saying, that O, that main, the SPG, I put them in the ticker. Then I put the yield, and then I put what it is. Walgreens, FedEx, AMC, senior living, I put what it is, and then I put the stock price. Then I reverse engineered it and said, how much do I need to get of this stock to make sure I get paid $30,000 a month? I'm gonna get a little bit of this. That's a good price. I'm gonna get a little bit of this. And you literally just multiply it out. It can be monthly, which I color coordinated mine to pink is monthly, or just quarterly. But you can do this for yourself. Now, I know some of y'all about to screenshot this. Do not reproduce it. I'm gonna come find you. But you can do it for yourself, trust me. And if you are in the Discord or the Ladies Lounge, you know I give you access to this, just like Twyla gives you access to her amazing earnings spreadsheet. So the idea is, and this looks complicated, but I literally was just typing it out in Excel, you know, as I'm going through it. So the idea behind all of this is, guys, that whether it's financials or whether it's real estate investment trusts, there are ways to make your money make you money. I think I said that right. You know, as you're making money, make sure you get paid dividends from the companies that you want to invest in. All right. So next slide, and we're going to take y'all's questions. All right. If you have a question, go ahead and get it. Raise your hand, put it in the chat. I was talking fast, y'all. Parched.
Oh, good. Good job. Listen, y'all gave us like, I was like, damn, like maybe I should go upstairs and get my diploma and walk out here with my cap and gown.
I have a story. So y'all know Desi Banks, he texts me while I'm on here. I'm like, I'm in the stock class. He's like, I'm over by your house. So he pulls up on me. He hears y'all talking. He's talking about, who is that? I'm gonna be in this class. I said, be quiet. He right here got his mind all up in the stock class. Literally talking about, who is that? She sound like she know what the hell she's talking about.
Come on, Desi. Come on over to the cheat code.
Come on over
absolutely
to the cheat code.
do know what we're talking about. So yeah, come on over here with us.
Come on over here. This is the Cool Kids Club.
He said, I'm coming, honey. I'm like, be quiet. I'm over here taking notes. I'm writing down. What
her spiral notebook.
Chipotle, mall, DC show, the spa, airport, Starbucks, Yes Jeans, all these places I done went to.
Come on.
I legit just ordered some Chipotle. Like I was literally eating it off camera, like, yo, they're here. So I was definitely in CMG. That's one of my favorite stocks.
That's low-key one of Chrissy's favorite. CMG, that's one of Chrissy's favorite stocks. If y'all have a question, put it in the chat. We're gonna give you a little bit of time. We got a little bit of time. Or you could raise your hand either way. Also, if y'all have any questions, you know, from the day before or just today, we all are here to answer your questions. Once again, no question is a dumb question because we've been there, trust me.
Not at all. And like I said,
I have a question.
Oh, go ahead.
Okay. My fault. I don't see
My bad. I didn't mean to cut you off.
No, you're good. Go
But
ahead.
I wanted to see if you could put back on the screen how you reverse engineered that to show how you would make your $30,000 a year just by obtaining those. What did you call them again? I'm sorry. I'm trying to look on my notes. Yes, your REITs.
So I don't know if we have a back button, but I'm gonna tell you how to do it because we ain't reverse engineered the back button yet. It's okay. So what we do. Oh, there it is. Oh, so this is a sample, right? So what you're going to do is you're going to go to REIT.com or NASDAQ.com, the dividend section. And you're just going to go, I use spreadsheets for like everything in life, but like Twyla does too, she's spreadsheet queen. So the first column, you're just going to write out, just like how we went on REIT.com, you're going to write out, you know, whatever the name of this stock is, or not stock, the REIT is. So if like, for example, the top line of this, it says Walgreens, FedEx, AMC, Walmart, Home Depot, 7-Eleven, Dollar General. There's a whole bunch more. It's owned by Realty Income, which is ticker O. Okay. And at the time I made this spreadsheet, once again, the stock price changes every day. But the time I made this spreadsheet, it was 4.9%. And the stock price was 68.42%. But it paid out 24 cents a month. So what I did was I said, all right, how many of these stocks do I need to give me my goal of $12 a month? Now, this is just projected. I just did a sample, but you could do like all $8 stocks. You could do all $10 stocks. You could do like one, like SPG, which is 138 or 140. And then do like, you know what I'm saying? You can mix and match it however, because there's so many. And I'm gonna give you another major key since y'all are here. You can go to suredividend.com, SUREDIVIDEND.com. And what they do is they do an extensive list of like aristocrat stocks. So aristocrat stocks are something that has a high market cap, meaning they're bringing in a lot of money, stable P/E ratio, and a stable dividend yield. So they'll give you like, they'll section it out for you. So it makes it a little bit easier to build this yourself. But once again, this is just from me, you know, saying, okay, this is how much I want to make a month. or this is how much I want to make a year. How do I reverse engineer it, kind of thing. So you can do it. I mean, you can do it the forward engineer way and just say this stock pays me 25 cents a month. I'm gonna do one stock and then make, or I'm gonna do 4 stocks and then make $1 a year. However you want to do $1 every 4 months. I mean, so however you kind of want to do it is up to you. Does that make sense?
Yes, ma'am. Thank
All
you.
right.
This is Jen. Hi, ladies. Great job as always. So are you saying that your profit, for example, is $30 a month or 30,000 a year? 30,000?
No, my essential goal, like I want to get to the point where, and this is over, once again, I'm not saying go out and buy $3,000 worth of ode tomorrow, but my goal is essentially to have like $30,000 a month, $100,000 a month. Just
okay,
kind of holding it, right? So I look at stocks that I already use, and then I create a spreadsheet that will help me get to my goals. So over time, I'm going to get there. I'm not saying today I'm gonna get there, but if I keep looking at these numbers, I'm like, all right, today I got 2.
I got you. So you're setting up a plan to get there.
Yeah, this is my plan to ultimately get there, so I can keep looking at it and tracking how much money I'm spending and how much money it's making me every month or every quarter.
Okay, understood. I have a question for Twyla. Am I saying her name correct? Twyla?
Yeah, Twy. Come on, Twyla.
And it's regards to the financials, the fundamentals of the financials. When you're looking at a company, right, and you're looking at their, like if you were to go to Yahoo.com and you wanted to research Apple, what are you looking at specifically? Is there like 5 steps that you look at quickly just to gauge, or are you looking at every aspect that's listed for the company, their balance sheet, their income statement? I don't know if I'm saying the right thing.
Right. Income statement. So there's an income statement, balance sheet, and a statement of cash position. For me, as I said, I'm a fundamental trader. So there are key aspects that I look for when I look for long-term investments. I look, of course, at the PE ratio or the PEG ratio. I look at the earnings per share. As I said, I hold blue chip stocks. So as Kim is talking about dividends, I look to see what their dividend yield is and how much their dividend is. And I'm looking at their net income and I'm looking at their cash position. Because as I said, for me, I'm very big on profitability. So if a company is returning profit to their shareholders, then that means that the likelihood of my stock appreciating over a certain amount of time will be so much greater. So I do look at key elements for myself. But I know, like, you can look at any analyst and ask any analyst, they are probably looking at different ratios. Like they have, a cash ratio, a quick ratio, how quick they convert cash to liquid means is definitely something as well. So there are definitely, like I said, there are an abundance of financial ratios that you can definitely look into. For me, I just look at those probably like 5 or 6. And I will say that in my investments, I beat the S&P average of 12%. I trend 50 to 60% on all of my long-term holds. So just by the metrics that I look for. So I don't necessarily get too bogged down in the details. As I said, I look at profitability ratios, which is like the, like I said, earnings per share, the PE ratio, net income, and looking to see what their cash position is, how liquid they are, looking at their balance sheet to see how quick they can convert cash in short terms, cash into, actual liquid funds. I look at that as well. And then I make my decision based on that. And as I said, I look at dividend as well, but there are companies that are in my portfolio that are growth companies that will not pay a dividend, but the appreciation of the stock over a longer period of time will definitely be greater than possibly holding out for a smaller dividend.
All right. So what I got is a 6 things that you look at. You look at the PE ratio, you look at the dividends, net income, cash position. Oh, I can't even read my own writing. Something.
Right. So earnings per share.
Okay, let me go over it again. You look at the PE ratio, dividends, net income, cash position. What's the other 2?
Earnings per share.
Oh. Couldn't even understand my writing. Earnings per share, and the last one?
Well, I also look at debt as well. So debt,
And debt.
I look at the company's debt as well. So if they're too over leveraged in debt, I will not be participating in any of that
Okay.
foolery. So yeah, I take into consideration debt, but I also have special calculations that I run specifically for calculating debt.
Oh, okay.
She said tomfoolery.
You go a little bit further down. Okay, thanks very much. Appreciate it.
No problem.
She said she definitely was writing like Sonic the Hedgehog.
Right.
Huh? Say that again.
She said you were writing like Sonic the Hedgehog.
Real fast.
We
Oh,
have
yeah.
Shay, Ron with their hand up.
Okay, so what was the difference between the two websites, the RIT.com and the NASDAQ? What are we searching for between those two?
So the REIT.com will give you like a snapshot of the company as a REIT, or the REIT itself. So it'll tell you like the share price. You can get the company information. You can even kind of like Twyla said, if you own shares of it, you can actually download the PowerPoint that will give you literally that they give investors that shows you, you know, how much they're spending, how much their P&E ratios, how much their market cap is. And then I think for I pulled this earlier for realty. If you look at O is the one that owns Walgreens, 7-Eleven, Dollar General, all those. You can even look at how many 7-Elevens they own, how many Dollar Generals they own. You can look up where they are, all of that type of thing. So REIT.com gives you the breakdown of the REIT itself. If you go to NASDAQ.com/dividends, it'll give you the dividend payout schedule, the dividend calendar, and how much they pay on which date. And remember, by the X dividend date, you have to own it in order to get paid that. So there are just two different ways to look at a REIT or any kind of dividend, any company dividend.
Right. And as Kim is telling you about REITs, it's definitely great to invest in REITs, right? But you definitely want to have a diversified portfolio because REITs are based on the market and mortgage and things of that nature. So, you know, if the mortgage sector, if anything in the macroeconomic shifts the housing market or any like commercial, it's going to alter, going to alter your REIT. So we always, you know, encourage you to have a diversified portfolio because just as, you know, REITs pay dividends, although they're required to pay 90% out, a lot of stocks pay out dividends as well. So you can definitely add it to your spreadsheet to look at that. And you can definitely get dividends on that and still be holding a diversified portfolio. So it's great to have REITs in your portfolio. I definitely have some, but just don't over leverage your portfolio with REITs because you want to be diversified and exposed to a lot of different sectors and industry where you can get the greatest return for your money that you're going to put in. And since it's fractional shares, you don't necessarily, as Kim said, you can look at the price. Like if you look at Tesla and say, oh my God, it's what is the 1,200, or you know, you don't have to come out of pocket that 1,200. You can buy fractional shares, and then what ends up happening with that dividend payment, whatever fraction that you owe, that's the fraction that you get in a dividend payment. So please, so please, you know, definitely diversify your portfolio. Great to have REITs. They're going to return 90%, but you definitely want to be exposed to a lot of different areas so you get the benefit of being exposed in the appreciation of those sectors as well.
Oh, definitely. And what Twyla was saying, like that REITs, the NASDAQ.com/dividends will give you all different dividends. So like, I think the most popular one right now is Apple, Starbucks, and Microsoft, but XOM gives good dividends, like ExxonMobil, Starbucks gives good dividends.
Lockheed
so like,
Martin.
Yeah, she knows them. I'm gonna tell you.
Yeah, I'm telling y'all, like I'm heavy in the dividends, and like I said, I do invest in REITs, but I definitely invest in dividend stocks as well. So, like I said, just you want to diversify your portfolio, and you can buy REITs. You have to have a brokerage to buy REITs because it's actually a stock; it's a ticker symbol. So you definitely have to have a brokerage in order to be able to acquire those shares. So you're definitely going to need a brokerage, as we said, whatever brokerage, as Quay discussed yesterday, that's feasible for you. But you can definitely put it into a brokerage. As Christy and Kim says, I have a long-term portfolio that just holds all of my shares. And then I have my other accounts that I use for trading. So you definitely want to separate that information out and have something for long-term and evaluate it every year, every 3 years. Look at the reason why you got into it, see if it's measuring up to the reason why you got into it. And if it's not, then shift it out. Because as I said, you want to be in a position of profitability. And if the company, the number one requirement is that they return profit back to their shareholders. And if you're not getting profit, get it out your portfolio.
Girl, say that part. Anyone else? We have about 2 more minutes. Anyone else have a question? You want to raise your hand and ask it? We got about 30 seconds on the clock. Thank you guys also so much for showing up. And this is not lighthearted reading. You hear me? It is.
Y'all literally sound like college professors.
Y'all really do.
Equation of the reach. I'm like,
she said, I'm scared.
I'm scared, y'all. No, for sure.
But look, honestly and truly, the way that we talk to y'all, we do this on an everyday basis, and it sometimes takes 2, 3, 4 times to hear it. So you're like, oh my God, that makes sense, right? So the same way, be patient with yourself. Like, take it a little bit by little bit. If you got to watch this recording 3, 4, 5 times, and then you're like, I know a REIT, or like, I love a dividend. Like, do that for yourself. You know what I mean?
Somebody said, where did they get the recording? You guys, it'll be emailed to you guys. If you purchase this stock class, 5-day stock class, you will get the recording to your email.
All right. Well, we're right at 9 o'clock. First of all, shout out to the Ladies Lounge for holding it down tonight.
Shout out to Twyla. Shout out to Kim. You guys did a great job.
And Chrissy held it down so hard. Chrissy was cracking jokes. Look, y'all, we are known as the detention kids, because just like Quay was saying yesterday, Quay was like, Kim, Keo, you know, y'all gotta pay attention. We do this all the time. We literally be going on people on an everyday basis. So, you know, have fun with this. It's a journey. I want to shout out B Simone for putting this on for y'all. Like, this would not have happened in here.
Thank you for having us. Thank you for letting us, you know, expose this information to your following. And, you know, you guys can, as Kim said, come follow us. Like, we do the Ladies Lounge on Saturday. Come in. You know, Kim says we're underrepresented in this element, and y'all, I'm a Black accountant, so y'all know it ain't a lot of us. So just come in and ask the questions. You know what I'm saying? No question is a dumb question. We are here to assist. You can definitely hop on. We appreciate your time that you put into listening to us talk. We know it is a lot of information to digest in one setting, but watch the recording, ask questions, do your due diligence, and you know, we're here to assist.
This is only day 2 of 5, so y'all review it.
She said, "Let it settle, let it trickle, let it
marinate."
I have a quick question before we
about Chipotle and 7-Eleven. In my mind, I was like, now I'm hungry.
Don't even talk about Ulta. Don't talk about Ulta, the Guess, the Gap. All that good stuff, the makeup, the diamonds, Signet Jewelers. Oh, anything you want to tap into is on the stock market. You can get
100%. Thank you, Ladies Lounge, for
today. I have a quick question before we leave.
Oh, Jimmy sliding in there in the last 30 seconds, girl.
Sorry, I have a quick question. Today I watched, what was it, Stock and X? Is there one for the crypto?
Yes. What's the name of his? Crypto Clash. We have a Crypto Clash show. Like, all of us actually are on.
When is that?
Sundays.
Sundays?
It's on when?
Sundays at 8 p.m.
Crypto Clash?
Crypto Clash, correct.
Okay, 8 p.m. Sunday. Thank you.
All right, y'all. We will see y'all tomorrow.
Thank you,
Shout out to B tomorrow.
Y'all tomorrow.
Thank you. LL gang. Hold on, this
Bye.
Ladies Lounge, there we are.
Gang, gang.
Gang, gang.
Bye.
Good night.